Hey guys, welcome to Market Minds, and in today's video we are talking about the introduction of candlesticks. So this is a very basic of candlesticks. That means it is a very basic of technical analysis. You can say as this as a foundation of the technical analysis. So without this you'll not be able to understand technical analysis, nor you'll be able to analyze the markets. All right. So in this video, what I'm trying to explain is the basics of candlesticks, how a candlestick looks and the types of candlesticks, the history about the candlesticks, and some fundamentals about the candlesticks. So without a further ado, let's get started. So history. A candlestick chart, also called as Japanese candlestick chart, is a style of financial chart used to describe price movement of a security, derivative, or currency. Each candlestick typically shows one day, thus one chart may show 20 trading days as 20 candlesticks. Candlesticks chart can also be built using intervals shorter or longer than 1 day. I know most of you people this is too technical, and for most of you people this has just gone away, right? So I'll explain you in a very simple terms so you did not have to crack your head on this kind of big technical definitions. All right, so let's understand the history behind the candlestick charts. All right, in 18th century in Japan, there were rice traders who wanted to sell the rice farmers who wanted to sell the rice to the market, or what you call as mandi today, where all the rice has been taken. So there used to be the price fluctuation. So obviously once any crop you see, there's always a price fluctuation. Let's take onion for example. Onion has at a different interval period of time. Onion has sometimes 40 rupees kilo, sometimes it goes to 100, and sometimes it goes to 200 kilos. All right. So this all works on one thing which is called as supply and demand, right? So we all know that these things work on supply and demand. The same thing in 18th century, what happened was the rice traders, once they were trying to sell the rice, few people had to come from a very long way. So that means a very long. Now let's assume a mandi is somewhere here. For example, let's assume the mandi is in Mumbai, and some people had to come all the way from Nagpur maybe. All right. So while coming, the traveling time would obviously consume, and till they come, the price might have decreased, or maybe the market has been closed. All right. So what happens is, to mark these prices, what people used to do is people used to draw candlesticks. All right. So people used to draw candlesticks like this in order to understand the price. So what was the highest price where the rice was sold, and what was the lowest price where the rice was sold, and what all moment had happened. A candlestick can be of many types. So a candlestick can be, one candle can be of 15 minutes. So that means this whole 15 minutes, in that particular interval of 15 minutes, what all has happened can be shown in one candle. It can be even of 5 minutes. All right. It can be of 1 minute. So the typical candlesticks in a technical analysis, that means once we are doing a technical analysis, we go with 1 minute, 5 minute, 15 minutes, 30 minutes, all right, 1 hour, 4 hour, and 1 day, 1 week, and 1 month. So we have total 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 types of time intervals when it comes to technical analysis. This is a typical time frame what technical analysis analysts use. So 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, 1 day, 1 week, and 1 month. All right. So these are the typical time frame. I hope you guys are understanding what I'm trying to say. All right. So let's understand who exactly invented the candlestick charts. All right. So he is the man who, Mynds was the person to invent the candlestick chart. A typical candlestick looks like this, guys. All right. So I'm going to come to that very soon. So candlestick charts are thought to have been developed in 18th century by Mynds, a Japanese rice trader. They were introduced to the Western world by Steve Nissen. All right. Steve Nissen was the first person to be called as a CMT. All right. What is CMT? CMT stands for Chartered Market Technician. All right. So Steve Nissen was the first person in the West to introduce candlesticks pattern. All right, candlesticks charts in the financial market to analyze the market and the price movement of the market. All right. So in a very simple term, Monesa Homa was the person who created the candlestick charts. So these are always called as Japanese candlestick charts. So there are different kinds of charts nowadays, but this is the most common used candlestick charts for an analysis, and it is understood by many different people. All right, guys. So I hope I am clear till here. If there are any doubts, please feel free to comment, and we are always there to help you out. Okay. So this is a very basic video. Do not get confused till now. All right. So Steve Nissen was the person who introduced a book about the candlesticks, and he was the person who introduced candlesticks in financial market. So do not get confused. Monesa Homa was the inventor of candlestick charts, but Steve Nissen was the person who introduced those candlestick charts in financial market. All right. And he was also one of the first chartered market technicians. All right. So now understand, let's look at how a typical candlestick looks like. All right. So it's an overview of a candlestick charts. So this green one, we call it as bull, and the red one, we call it as bear. All right. So understand, bull means it goes up. Bear means the market goes down. I mean, the price goes down. Bull means the price is going upwards. Bear means the price is going downwards. Understand, these are the very common terms used in the financial market. Bull means the price is going upwards. Bear means the price is going downwards. I hope I'm clear. Again, if you want me to explain, bull means market or the price is going up. Bear means the market is going down. All right. So there's a good example shown in the Scam 1992, the series, why it is called as bull and bear. So bull basically uses its head to push the market. So push someone, whoever attacks, it uses his head to push it up. So that is why we call it as bear, a bull. And bear, what it does, it uses its claw to defend someone, right? So bull always uses from down to up movement, and whereas the bear, it uses its claws from up to down movement. So that is the logic behind bull and bear. All right. So how exactly a typical candlestick looks like? All right. So this is a bull candle. All right. And this is a bear candle. Okay. I'm sorry. Bear candle. All right. So a bear candle always goes like this. A bull candle direction is upwards. All right. A bear candle direction is downwards. A bull candle direction is upwards. All right. Now let's understand this particular part. All right. So this line is called as shadow, tail, or wick. It can be either called anything. Some call it as tail, some call it as wick, some call it as shadow. All right. So a bull candle basically opens from here. This is an opening part. All right. This is an opening part of a candle. All right. And the price goes on like this. And this is the highest point. Now let's assume this particular candle, once again, I'm sorry guys. So this particular candle can be of any time frame. Now let's assume we are looking at 15 minutes. All right. So the overall price happened, that means the overall price movement in that 15 minutes has been recorded in this one particular candle. All right. So this particular candle consists of those 15 minutes price intervals. So what all has happened in that particular 15 minutes has created this candle. All right. So in that 15 minutes, this is the highest point. All right. And this is the closing price. And this is where it opened. And this is the lowest point where the sellers have sold the market. All right. So always remember one thing, any sort of market analysis, they require buyers and sellers. All right. So without buyers and sellers, there is no movement in the market. All right. So this is nothing but a tug of war, you can say. All right. A tug of war between buyers and sellers. That is how a price movement happens. All right. So now what has happened here, if it's a bull candle, that means buyers have pushed the money in the market. They have trying to buy the market from every possible places, and they have taken market to this particular level. All right. So this is how a market basically looks like. Okay. And this is the lowest point. That means if the sellers have tried to sold the market, it has come to this lowest point and it has gone to till this upwards point, and this is the highest point in that particular time frame, and this is where it has closed. Now let's assume once it closes here, after that let's assume the sellers have entered the market, the bears have entered the market, and they're trying to sell the market. All right. In that case, what happens? How does a bear candle looks? It opens vice versa, guys. So in a bull candle, it opens from below, whereas the bear candle, it opens in the top. All right. So once it opens here, the price direction goes downwards. That means bull means the price has to go down, right? So this is the body of the candle. That means the price has gone down. So this is the lowest point of a candle. This is the lowest point, the lowest price in that particular time frame, as we're talking about 15 minutes now. So in that 15 minutes, this is the lowest point it has made, which we call it as shadow tail wick. All right. This is the lowest point, and this is the highest point which has been made. All right. So this is the highest point and this is the lowest point, and it closes here. So the bull candle closes upwards, whereas the bear candle closes downwards. So it's a very simple to understand. So typically it is not always green and red color. So people modify it according to their color. Someone use black and white, some use blue and other colors depending on their perception and their way of trading. All right. So do not get confused. Only the candle should look like green and red, but most commonly are used green and red. That is why to explain you guys, I have used red and green color. All right. I hope you guys are understanding what I'm saying. So let's move to the next chart. Understanding the types of candles. All right. Do not get confused, guys. I'm not going to explain you everything at once and make you confused. These are basic things. And to make you exercise these things, I'm just showing you what kind of candlesticks there are in the financial markets. All right. So these are some of the common candlesticks which you look. All right. A big green candle. All right. A big green candle has equal shadows and a big body. All right. A big body. All right. A big green candle. The same thing in the big red candle. It is a bear candle. I hope so, because open is here, guys, and closes here. Here it opens here and closes here. High is this one. Low is this. Here low is here. High is this one. All right. Do not get confused, guys, with the bear and bull candle. All right. So this is a typical candle, which we call it as big green candle, and this we call it as big red candle. All right. It doesn't have anything much. All right. So this we call it as doji. All right. It doesn't have a body. So it doesn't have body. That means buyers and sellers both have pushed the market. Do not worry. I'm going to come with a detailed video in the next part where I'm going to explain each candle and its type of interpretation. All right. What exactly happens after this candle. All right. So in this video, what I'm trying to explain is just you can have a look of all these charts, all these candles, I'm sorry, and exercise it and make your eyes exercise to these kind of candles in the typical chart. All right. So this has no body. It has big shadows, and the price where it has opened and closed are almost same. All right. Or maybe same. Sometimes it is exactly same. Sometimes it is almost nearby that value. So this we call it as doji. All right. And now this is a dragonfly doji. All right. What is a dragonfly doji? Opens and closes at the same place. There is no high point. So wherever it has opened from there, the market has fallen down. It has made a low, and again it has recovered back to where it has opened, and open and close is at the same price, but there is a good amount of low. A long shadow, open and close is at the same place. In a gravestone doji, this is nothing but the vice versa of this one, what happens is open and close is the same and it makes a new high, but there is no low. All right. So the market has not gone anywhere down. It has directly opened. It tried to go as much as up it possible. Then again, it pulled back to its price where it has opened. All right. So this is, we call it as gravestone doji. All right. Now next, hanging man. So what is an hanging man? It has, so what is a hanging man? It has a body, a small body and a long tail. All right. A very long tail and a small body. That means the market opened here. It tried to go as low as possible. Then again, it recovered back, but it did not close at the same price where it opened, but below the open price. So we call this as hanging man. All right. So next is a hammer pattern. So hammer pattern is, it opened here, it went a little bit high and it closed at its highest price possible. And before going high, it have also made a low. It has made enough low, a small tail, but a good body. What we call it as hammer. So it somewhat looks like a hammer also. So this we can call it as a handle and the hammer. This is a hammer part, right? So this is what we call it as a hammer. All right. Inverted hammer is in vice versa. It is not always a bear. It can be bull also. This one also can be bear and bull. This also can be bear and bull. All right. So inverted hammers is a vice versa. It opens here. It goes as high as possible. And then it creates a low and it closes at its lowest price without any tail. All right. So this one we call it as inverted hammer. Now spinning top. So you know what is a spinning top, right? A spinning top which has, I hope we have all played with a spinning top in our childhood. So it is same thing. The shadows are equal and there is a body. All right. So this means the market has gone up, the market has gone down, and also it has closed somewhere in between. All right. So shaven head is basically, it has the same body as much as the same tail. So we call this as shaven head. All right. It has the same body and the same tail. Shaven bottom, it has the same body and the same tail in an inverted way. All right. This is a very strongest candle. We call it as Marubozu. That means there are no tails here. There is no shadows here. It has directly gone up from the point it has opened. So it has opened here. It has gone up, and it has closed. That means the buyers were so furious in buying. They have just bought the market from every point and they've created a Marubozu candle. This is a very strong interpretation, which I'll be coming in the next video. Please do subscribe and continue to watch. All right. I hope you guys are clear. So again, let's discuss again what we call this one as big green candle, big red candle, doji, dragonfly doji, gravestone doji, hanging man, hammer, inverted hammer, spinning top, shaven head, shaven bottom, and Marubozu. All right. So guys, what you need to do is you need to look into a chart. So a typical free chart is where you can look is at investing.com. All right. There you can find a technical analysis and everything. So you can open investing.com and you can start exercising these charts and try to understand, try to figure out which chart, which kind of candle is where in the typical chart. Use any time frame, guys, that doesn't matter. At least have some exercise to your eyes so that it will be easy to understand. So I hope everything is clear so far. And if you do not have, if you have any doubts, please do feel free to comment down and we'll be more than happy to help you guys. So summary of today's class was, let's have a recap. So we understood what is the history of candlestick. All right. So history of the candlestick charts. Candlesticks charts were invented by Japanese rice trader called Mohisa Homo. And the second thing is who invented was, you know, right? And who bought it to stock market? It was Steve Nissen, right? And I hope we have seen what a typical candle looks like. So the typical candle looks like this one. It can be either bull or candle or a bear candle. and the types of candlestick charts which we discussed just now. And I hope this is clear to you guys. Thank you for joining this class, guys, and I hope you guys have liked this video. And please do wait for the second part, in which I'm going to explain each candlestick and what are the types of interpretation each candle does. And thank you for this class.